When people think about index funds and ETFs, Vanguard is usually the first name that comes to mind. And honestly, there's a reason for that. Vanguard didn't just participate in the index fund revolution, they practically built the blueprint for it. What started decades ago with a single index fund has exploded into an empire of investment products covering nearly every corner of the market you can think of: large cap, small cap, international stocks, dividend funds, growth funds, value funds, emerging markets, real estate, ESG investing. If there's a slice of the market somebody wants exposure to, Vanguard probably has an ETF for it. And because Vanguard has become the default answer for millions of investors trying to build long-term wealth, we wanted to do something most people never actually take the time to do. Instead of listening to opinions, slogans, or generic advice about just buy ETFs, we wanted to look at the actual numbers. So we analyzed 45 different Vanguard stock ETFs and backtested every single one of them. And the results were fascinating. Because out of 45 Vanguard ETFs tested over a 5-year period, only one actually lost money. Not underperformed, not barely stayed flat, actually lost money. An investor who started with $10,000 ended the entire 5-year stretch with $9,992. That means after half a decade of holding the fund, after one of the strongest bull market environments in recent history, after reinvesting dividends and staying fully invested the entire time, the investor would still have less money than when they started. Today we are going to reveal which ETF that was, why it performed so badly, which Vanguard funds completely dominated the rankings, and most importantly, what all this data actually means if you're trying to build a serious Vanguard portfolio right now. Welcome back to Dividend Desk. Now, before we jump into the results, let's quickly talk about the framework behind this analysis, because honestly, if the assumptions are garbage, the conclusions are garbage too. Every ETF included in this analysis had at least 5 years of historical performance data available. We looked at 2 different time periods. First, we looked at the full 2023 calendar year, from January through December. Then we looked at the longer-term period from January 2019 through December 2023. For every ETF we assumed the exact same starting conditions, a one-time lump sum investment of $10,000 at the beginning of the period, no additional contributions, no dollar cost averaging, no withdrawals. Every dividend earned was automatically reinvested. Simple, clean, consistent across the board. And that consistency matters because, let's face it, investors love comparing investments under completely different conditions. One person adds money monthly, another invests during a crash, another reinvests dividends while someone else doesn't. Then people wonder why the comparisons become messy and, honestly, kind of useless. This test strips all that away. Every ETF had the same starting line. Now let's get into what actually happened. Starting with 2023, the top-performing Vanguard ETF was MGK, the Mega Cap Growth ETF. $10,000 invested at the start of the year grew to over $15,000 by the end. That is an absurd return for a single year. Right behind it were VUG, Vanguard's Growth ETF, followed by VONG, the Russell 1000 Growth ETF, then VOG, the S&P 500 Growth ETF, and ESGV, Vanguard's ESG US Stock ETF. And immediately, there's a pattern that just jumps off the page. Growth absolutely steamrolled the market, not just growth in general, mega-cap US growth. The largest tech-heavy companies dominated 2023 so aggressively that the top of the leaderboard basically became a parade of funds heavily concentrated in companies like Apple, Microsoft, Nvidia, Amazon, Meta, and the rest of the mega-cap giants. This is important because people love pretending all index funds are basically interchangeable. They are not. A fund tracking mega-cap growth stocks behaves very differently from a fund focused on international value stocks or dividend-paying companies, and in 2023, growth investors got rewarded aggressively. Meanwhile, the worst-performing ETFs tell the opposite story. At the very bottom was VNQI, Vanguard's Global ex-US Real Estate ETF. Then came VYM, the High Dividend Yield ETF, followed by VWO, the Emerging Markets ETF, MGV, the Mega Cap Value ETF, and VTV, Vanguard's Value ETF. Notice what's happening here. Value lagged, international exposure lagged, emerging markets lagged, real estate lagged. Meanwhile, US megacap growth completely dominated. That divide became one of the biggest themes throughout this entire analysis. But there's something really important people need to understand before they start panic selling every underperforming category they own. Every single Vanguard ETF in the one-year test still finished positive. Every one, even the worst performer, still made money. That matters because investors have this terrible habit of treating relative underperformance like absolute failure. If somebody makes 10% while another investor makes 30%, the first investor suddenly feels like they got destroyed, even though they still grew their wealth substantially. Comparison poisons rational thinking in investing, and honestly, social media has made this problem infinitely worse. Somebody posts a screenshot of a growth portfolio up 70%, and suddenly investors holding diversified funds start feeling like idiots because they only made 12%. That mindset is dangerous, because investing is not a competition to see who can temporarily hit the highest number during favorable market conditions. It's about surviving long enough for compounding to work. Now, the one-year results are interesting, but 1 year is basically financial weather. 5 years gives a much clearer picture of actual trends, and this is where things get really interesting. Over the full 5-year period from 2019 through 2023, MGK was still the king. $10,000 turned into approximately $25,600. That's not just good performance. That is dominance. Second place was VONG, then VUG, then VUG, followed by MGC. And once again the pattern stayed exactly the same. Growth dominated the rankings, megacap exposure dominated the rankings, US equities dominated the rankings, the funds sitting near the top all shared similar DNA. Heavy exposure to the largest American companies during one of the strongest growth cycles in modern market history. Now here's where things get brutal. The only Vanguard ETF that actually lost money over the full 5-year period was VNQI, the global ex-US real estate ETF. $10,000 became $9,992. Think about that for a second. An investor sat through 5 years. They stayed patient. They reinvested dividends. They ignored volatility. They trusted the process. And after all of it, they still ended below where they started. That's painful. Especially because this happened during a period where the broader US market absolutely exploded higher. And this is why blind diversification, without understanding what you own, can become dangerous. A lot of investors think diversification automatically protects them from bad outcomes. It doesn't. Diversification spreads risk, but it also spreads mediocrity if you diversify into weak assets during unfavorable market cycles. International real estate got crushed by multiple pressures at once. Slower global growth, currency headwinds, weak international markets, interest rate pressure, different economic recoveries across regions, all of it compounded together into terrible performance. Meanwhile, US megacap growth was basically operating like a completely different universe. The contrast could not have been sharper. Now after VNQI, the other weakest performers were VWO, Vanguard's Emerging Markets ETF, then VPL, the FTC Pacific ETF, followed by Vanguard's International Small Cap ETF and ESG International Stock Funds. Again, the same pattern keeps showing up. International exposure struggled badly compared to US growth. Now, does that mean international investing is dead forever? No. And this is where investors need to stop thinking in straight lines. Markets move in cycles. Leadership rotates. The strongest performing asset class over the last 5 years is not guaranteed to dominate the next 5 years. In fact, history usually punishes investors who assume current winners stay winners forever. That's one of the most dangerous psychological traps in investing. People look backward and assume the future will simply continue the same trajectory. That mindset works beautifully right until it suddenly doesn't. Because if you zoom out historically, there have absolutely been long stretches where international markets outperformed US equities. There have been decades where value stocks beat growth. There have been environments where dividend-paying companies crushed speculative tech stocks. Market leadership rotates constantly. The problem is that investors usually rotate too late. They chase performance after the big gains already happened. That's why so many people piled into growth after massive rallies instead of before them. Humans naturally extrapolate recent success into the future. And, sometimes that works for a while until the market changes character and people get blindsided. Now let's talk specifically about the international ETFs because this category produced some fascinating results. Out of all Vanguard international-focused ETFs, the strongest performer over both the 1-year and 5-year periods was VT, Vanguard's Total World Stock ETF. And honestly, this result makes sense because VT is not purely international. It includes both US and international exposure in one globally diversified package. That US exposure helped massively during a period where American stocks dominated the world. But again, and this is really critical, historical performance is not prophecy. Investors constantly confuse past returns with future guarantees. The market doesn't care what performed best over the last 5 years, it only cares about what happens next. That distinction matters more than people realize, because one of the easiest ways to destroy your returns is to chase yesterday's winners after they already became expensive. And speaking of expensive, this brings us directly into large cap growth. The large cap category absolutely dominated this analysis. MGK, VONG, VOG, MGC. These funds consistently sat near the top across both timeframes, and honestly, if you understand what happened in markets from 2019 through 2023, this outcome is not surprising at all. The market became heavily concentrated in a handful of massive technology-driven companies with enormous profit growth, insane cash flow generation, and gigantic investor demand. Companies like Nvidia went from being strong businesses to market supernovas. Artificial intelligence exploded into mainstream investor obsession. Cloud computing expanded aggressively. Digital advertising recovered. Big tech balance sheets remained insanely powerful. And because these giant companies make up massive portions of growth-focused ETFs, those funds absolutely ripped higher. This is something many investors underestimate. Index funds are not equally weighted slices of the economy unless specifically designed that way. Market cap-weighted funds naturally become more concentrated in the largest winners. That concentration can become a superpower during strong bull runs, but it can also become a weakness if leadership reverses. Now, mid-cap ETFs produced a more mixed set of results. Among Vanguard's mid-cap funds, VOT, the mid-cap growth ETF, delivered the strongest 5-year performance. Again, growth exposure continued outperforming, but in 2023 specifically, VXF, the extended market ETF, slightly edged it out. And honestly, this category highlights something important about investing psychology. Most investors completely ignore mid-cap stocks. They're not as exciting as small-cap moonshots and not as dominant as mega-cap giants. They exist in this weird middle ground where people barely pay attention to them. But historically, mid-cap companies have often delivered very strong long-term risk-adjusted returns because they sit in an interesting sweet spot. Now, small-cap ETFs gave us another interesting twist. Over the 5-year period, VBR, Vanguard's small-cap value ETF, slightly outperformed VB, Vanguard's broader small-cap ETF. But in 2023, small-cap growth took the lead through VBK. This category becomes especially important when interest rates start moving aggressively. Small-cap companies tend to be more sensitive to financing conditions because many smaller businesses rely heavily on borrowing to fund operations and growth. When rates rise sharply, weaker small-cap companies can get hit hard. That's one reason small-caps struggled during certain periods recently. But here's the thing about small caps. When they run, they can absolutely explode upward. Small cap rallies are chaotic, violent, and fast. It's like watching shopping carts strapped to rocket engines. Now, let's talk about Vanguard's dividend ETFs because this category matters a lot to Dividend Desk viewers. Vanguard has 4 major dividend-focused ETFs, including both US and international dividend strategies. Over the 5-year period, VIG, Vanguard Dividend Appreciation ETF, delivered the strongest performance by far. $10,000 became over $19,000. That's a strong result, especially for a dividend-focused strategy. And this is something investors often misunderstand about dividend investing. Good dividend investing is not just about chasing the highest yield possible, because high yield alone can become a trap. Weak businesses often produce giant yields right before things go horribly wrong. VIG focuses more on companies with strong histories of growing dividends over time, rather than simply offering massive current payouts. Now, after looking through all 45 ETFs, a few conclusions become, well, impossible to ignore. First, simplicity still works remarkably well. Despite all the specialized funds available, broad market ETFs like VOO and VTI remain incredibly hard to beat for long-term investors. And honestly, this frustrates a lot of people because, let's face it, simplicity feels boring. Investors constantly want complexity because complexity feels sophisticated. People want tactical sector rotations, leveraged strategies, thematic ETFs, options overlays, macroeconomic timing systems, and these 12-layer portfolio structures that look like they were designed by a caffeinated hedge fund intern at 3 in the morning. But most of the time, simple, diversified investing quietly outperforms complicated nonsense over long periods. Second, not all index funds are equal. This is another myth investors really need to abandon. People throw around the term index fund like it automatically means safe, diversified, and guaranteed to perform well, but an ETF is only as strong as the underlying assets it holds. Some indexes are heavily concentrated, some are international, some are growth-focused, some are value-focused, some are sector-heavy, some are built around entirely different economic assumptions. An index fund tracking weak assets can still produce weak returns for very long periods. VNQI proved that brutally. Third, performance chasing is dangerous. If somebody looks at this data and immediately decides to dump everything into mega-cap growth because it dominated the last 5 years, they might already be late. And finally, diversification still matters even when it feels, kind of frustrating. This is the part aggressive investors really hate hearing during periods of concentrated market leadership. When one category dominates for years, diversified portfolios can feel inefficient. People start questioning why they even own those lagging assets. But here's the thing, diversification exists specifically because nobody knows the future with certainty. If investors always knew exactly which sector would dominate next, well, nobody would bother to diversify. The problem is, they just don't know. Nobody does. Not YouTubers, not economists, not analysts, not fund managers. Nobody consistently predicts market leadership cycles perfectly. And honestly, the faster investors accept that reality, the better their decision-making usually becomes. Why diversify? Because nobody knows the future. Now, if there's one thing this entire analysis should teach investors, it's that understanding what you own matters way more than just blindly buying random ETFs because someone online said they were good. A lot of investors today are building portfolios they barely understand. They own overlapping funds, duplicate exposures, contradictory strategies, random thematic ETFs, international funds they never researched, and dividend funds chosen purely because the yield looked high. And then, they wonder why their portfolio behaves unpredictably. If you own investments you don't understand, you're way more likely to panic when volatility hits. And panic is expensive because the market punishes emotional decision-making relentlessly. Know what you own. The investors who survive long enough to benefit from compounding are usually not the smartest people in the room. They're the people who stayed rational while everyone else lost their minds. That's the real game. Not finding magical ETFs, not predicting the next Nvidia, not timing every market cycle perfectly. It's just about consistently making rational decisions for long enough that compounding can actually do the heavy lifting. And, honestly, that's way harder psychologically than most people realize. Because investing sounds easy during bull markets, everybody feels disciplined when portfolios are climbing. But the real test comes when markets fall 30% and headlines start screaming financial apocalypse every 5 minutes. That's when investors discover whether they actually understood their portfolio or just copied something from social media. So, after analyzing all 45 Vanguard ETFs, here's the bottom line. If you want broad, long-term exposure with simplicity and historical strength, VOO and VTI remain incredibly strong core holdings. If you want more aggressive growth exposure, Funds like MGK and VUG have historically dominated during this recent cycle. If you want global diversification, VT offers broad exposure across both United States and international markets, and if you want dividend-focused investing, VIG stood out as the strongest long-term dividend performer in this analysis. But no matter what strategy you choose, just understand this clearly: there is no perfect ETF. There is no guaranteed winner. Anyway, drop a comment below with which Vanguard ETF you're holding right now and whether you think United States growth dominance continues over the next decade. Thanks for watching Dividend Desk, and we'll see you in the next one.